So I recently made a tier list for Warren Buffett's portfolio where I basically ranked all of his stocks in comparison to each other. And a lot of people asked me to do the same thing, but for Jeremy's portfolio from financial education. And a lot of people were saying that I should probably ask Jeremy for permission before talking about his portfolio. But guys, what you need to understand is that when you get to my level, when your channel is as big as mine, you don't really go around asking for permission anymore. I mean, most people are just grateful that you're willing to talk about them on your big channel. And by the way, me and Jeremy are like this. We hang out all the time. If I asked him for permission, he'd probably laugh because it's so silly. I mean, we go out to clubs with Graham Stephan and Joe Rogan all the time. It's how us big YouTubers live. But look, if it makes you guys feel better, I'll give Jeremy a call and I'll ask him for his permission. I'll do it for you guys, okay? Let me just hit dial here. All right.
Who the hell's this? Hello?
Hey, what's up, man? It's Ale.
Who?
Ale from Ale's World of Stocks.
Sorry, man, you got the wrong number.
Oh, wait, hello? Hey, you cut out there for a second. That was weird. So anyway, man, I know this is gonna sound silly, but my viewers wanted me to ask for permission to talk about your portfolio. I know, that's what I told them. I know, it's so dumb. Anyway, so it's cool. All right, thanks, man. Well, anyway, good catching up with you. We'll hang out sometime and grab a beer or something. All right, man. What's that? Oh, no. Jeremy. No, stop. Jeremy, I'm a big fan of your channel too, Jeremy. No, I'm a big fan of your channel too. All right, I'll talk to you later, man. All right, bye. No, no, you hang up. No, Jeremy, you hang up. He always does this. No, Jeremy, no, I'm not hanging up. No, Jeremy, you hang up. What's up, everyone? My name is Ale. Welcome back to my world of stocks. So in today's video, we'll be taking a look at Jeremy's public account, which he recently showed in a video. I'll have it linked down in the description. Make sure you check it out. He goes over a ton of details and a lot of information. It's a great video. But today we'll be taking a look at those 11 positions and we'll be ranking them in a tier kind of a ranking system. Now, if you're not familiar with what a tier list is, it's basically where you take things that are similar and you rank them in comparison to each other. Now, I did actually do this for Warren Buffett's portfolio, but in that video, I compare them a little bit too much to the broader market rather than to themselves. So going forward, I will try to balance it out a little bit and make sure that I do have at least one stock in every single tier so that we have a complete kind of ranking system in place for each of the stocks. Now, we'll be doing a rapid fire, quick opinions on this because I don't want to waste too much time. It's 11 stocks we got to get through. But just keep in mind that I am not judging these stocks based off of when Jeremy bought them or why he bought them or how he's performed with them. I will actually show you how they've done for him because I calculated how much he's up on each position. There's no question that Jeremy is a great investor. He made amazing calls on almost every single one of those stocks. But instead, I'm going to be looking at these stocks based off of today's prices, not when Jeremy bought them, but based off of today's prices. And I'm going to be looking at them for myself as a growth investor, dividend growth investor. I look for attractive stocks that have a lot of future potential over the long term at reasonable valuations. So that's some of the criteria that I'll use to judge these stocks. But again, these will be for myself, not based off of how they've performed for Jeremy. We already know that they've done very well for him, but these will be kind of for me, and we'll just rank them each in comparison to each other. As always, we'll be using 5 ranking tiers from S down to D. S tier will be the very best of the best out there and is considered the sort of God tier. The A tier will be very solid above average stocks, but not quite the very best. The B tier will be the average or middle of the road stocks that I think do have a lot of potential, but are also more risky, so I'm more on the fence on. And then the C tier will be the below average stocks that I don't really think are worth the risk. And then we have the D tier, which will be the absolute weakest stocks of the group. And these are stocks that are either way overvalued or have some deep fundamental problems with the business. Okay, starting with stock number 11, that's going to be Tapestry, ticker symbol TPR, coming in at around 3% of his portfolio. And Jeremy is currently up a massive 27% on this position in relation to where the stock is trading at the time of this recording. And this is mostly a fashion retail stock that owns famous brands like Coach, Kate Spade, and Stuart Weitzman. Now, the stock has been crushed over the past year, losing over half their value from their highs, and as a result, the valuation has come down significantly as their forward PE ratio is close to 50% lower than the sector median, while their PEG ratio is also about 27% lower as well. By the way, I get these figures from Seeking Alpha except for the forward PE ratio because in my experience they usually give a drastically different PE ratio than most of the other research sites out there, so I just use Yahoo Finance for that instead. In any case, they also pay out a very high dividend that yields over 5%, but is not currently growing, and when looking at their performance, they are still growing sales by a few percent a year, but it's very low growth overall. On top of that, online shopping is stealing foot traffic while their Kate Spade brand has struggled to grow for quite some time, and the result of that is also putting pressure on their profits as their EPS is expected to actually drop this year and only average less than 5% growth over the next 5 years. But with a cheap valuation and attractive dividend, TPR looks like a decent stock to hold. However, I'm not a big fan of retail related stocks at this time unless they are a disruptor like Amazon, and that coupled with the fact that I know nothing about the women's fashion industry makes this a B tier stock, as I'm still a little on the fence with this one, but I admit that it's close to being an A tier stock at this point. Okay, moving on to stock number 10, that's going to be another retail stock called Nordstrom at about 4% of his portfolio, and he is currently up around 11% on this position. Now, this is a retail chain of luxury department stores, but one of the things I like about Nordstrom is that they are already doing over 30% of their sales online, while also having cheaper versions of their stores called Nordstrom Rack that caters to shoppers on a budget. Now, like most of other high-end retail stocks out there, Nordstrom has been really struggling as the stock has plummeted close to 50% over the past 5 years, leaving them with a forward PE ratio that is 42% lower than the sector, although their PEG ratio is actually 14% higher, which I found a little surprising. That's because their profits are under pressure though, with EPS dropping close to 10% this year, while their sales are also expected to drop by 3% before returning to small growth the year after. Still, the valuation does look attractive and their dividend yields over 4%, although it's not currently growing. But given the harsh retail environment and low brick and mortar foot traffic, especially in malls because of the rise of online shopping, I'll have to put them in the C tier because I think Tapestry has a more attractive valuation, dividend, and performance, not to mention that I was looking for a stock if I was looking for a stock like Nordstrom, I think I would probably go with Macy's instead, who also has a cheaper valuation and a much higher dividend as well. Okay, coming in at stock number 9, that's going to be iRobot's ticker symbol is IRBT at about 4% of his portfolio, and to my knowledge this is the only stock in here that he is currently down on at about -6%. Now, I'm sure you guys have heard of iRobots. They're famous for being the leaders in robotic vacuum cleaners, although they do have other products as well. The stock is actually up close to 80% in the past 5 years, but more recently it crashed very hard, dropping by well over 50% just from their 52-week high alone. But surprisingly, their forward PE ratio is still higher than the sector by a double-digit percentage. That's likely due to the trade war tariffs hurting their margins, as their EPS is actually expected to drop this year by as much as 16%, despite still being expected to grow their sales by around 10% this year and the next. I can see why Jeremy gave this company a chance, as we're likely headed to a future where robotic vacuum cleaners are in almost every single home, and clearly iRobots is the market leader, at least for now, but I'm a little worried about an increase in competition coming from Asia, especially China, who sells robotic vacuums around half the price or less. I'm not saying iRobots won't be successful, and I do think that the stock might be fairly valued for their growth at this time, but I still think that there's much better stocks out there, so I'll put them in the B tier behind Tapestry since they don't pay a dividend and Tapestry's valuation is also more attractive. Alright guys, moving on to stock number 8, that's going to be Jeremy's favorite casino out in Vegas that also owns casinos and resorts in other parts of the world like the East Coast and Asia, and that's of course Wynn Resorts at about 4% of his portfolio, and he is currently up about 4% as well. Now, the stock is currently down close to 40% over the past 5 years and is down even more from their 2018 highs. A lot of that has to do with Macau, which is like the Vegas of Asia, where Wynn is one of the biggest players, and gambling revenue crashed over there in 2015 and then recovered the years after, which completely correlates with Wynn's own revenue. But because of macroeconomic issues, among other things, Macau has been struggling again, and as a result, Wynn sales are only expected to climb by about 1% this year before returning to their normally high growth rates after, which is likely thanks to the new Wynn Boston location. However, those investments are also taking a toll on their profits, as EPS is expected to drop 16% this year before recovering to almost 24% growth the year after. As a result, the valuation does look pretty attractive, as both their forward PE and PEG ratios are about 5 and 10% lower than the sector medians respectively, and Wynn also pays out a very nice dividend as well that yields over 3.5%. I'll put Wynn in the B tier right behind Tapestry because I don't think gambling casinos and resorts will ever disappear, but the valuation doesn't look overly cheap to me considering how exposed they are to the macroeconomy at a time when people are screaming recession and China continues to struggle with a trade war. Keep in mind that leisurely spending is usually the first thing that gets cut from people's budgets during a recession, and I'd have to assume that Wynn would be willing to cut their dividend in that scenario, considering that they didn't hesitate to do so back in 2015 when they were having major issues in Macau. It's a very close second to Tapestry. I almost want to put them in front of Tapestry, but I'll just keep them in the B tier right behind Tapestry for now. Okay, coming in at stock number this is stock number 7. It's going to be Elf Beauty at about 6% of his portfolio, and he is up close to 150% on this position, which is pretty incredible considering that I don't think he's had this position for a very long time. But anyway, I don't know much about Elf myself, but apparently it's a cosmetics brand that sells their products for affordable prices, appeals to a younger audience, and sells at various large retail chains like Target, Walmart, and Ulta, in addition to their website, at least according to their investor relations. Now, their sales were growing at huge rates in 2016 and 2017, but later fell off a cliff, going to negative growth last year, and that's expected to continue even into this year. Now, I'm not exactly sure why it's been dropping. From what I read online, it seems like the combination of a harsh retail environment and maybe an increase in competition is perhaps taking a toll on their business, but the result is that the stock has been getting absolutely destroyed in recent years. But it looks like Jeremy caught it at just the right time and rode the bounce back, as the stock has soared by more than 100% this year. As a result, their forward PE and PEG ratios are both 60% higher or more than the sector medians. Again, I won't pretend to understand the women's fashion and beauty industries, but this stock looks really unattractive to me at first glance, so it's going to go in the D tier. I'm amazed that Jeremy was able to squeeze out so many profits of around 150% out of this stock, and in recent videos he has stated that he's been cashing in profits, and to be honest, I have to agree with that move. I think he's making the right call there because anyway, hats off to Jeremy. That is very impressive that he got that high gains off of that stock. Anyway, moving on to stock number 6, that's going to be Uber. Ticker symbol is UBER, Uber, and that stock is about 6% of his portfolio, which he is currently up about 5% on. I'm sure you guys know about Uber and all the potential that they have, given that they're the leader in the ride-hailing market that just in the United States alone is expected to grow to over $75 billion by 2023, according to a new report from Statista. As a result, sales have soared by 43% last year and are expected to continue climbing by 24% this year and 32% the next. However, because they are a relatively new company, they are still very far from being profitable, as they've actually lost over $8 billion in the past year alone. Now, they only recently IPO'd this year, but so far the stock is down over 30% from its highs. Because of the lack of profitability, we have to judge the stock based off of their price to sales ratio, and that comes in close to 300% higher than the sector median. Granted, this is a startup company that needs time to really ramp up, and if they're able to do so successfully, they could end up being a major disruptor in the market, but I think they're going to face heavy competition from companies like Tesla and Waymo that will launch their own robotaxi fleets in the future, so it's not that easy to see where the stock is headed over the long term. By the way, I didn't even mention Lyft. That's obviously a competitor as well. But to be fair, they are working on autonomy themselves and are even diversifying into Uber Eats and Uber Freight as well. But as of right now, this is still a very high risk speculative stock that loses an enormous amount of money. So I'll put them in the C tier, but in front of Nordstrom, because I do think that they have a lot of potential if they can actually execute. Okay, that brings us to stock number 5, and that's going to be National Beverage, ticker symbol Fizz, at about 9% of his portfolio, which he is currently up by around 16%. Now, they're famous for their sparkling water drinks like LaCroix, although they do own other brands, but LaCroix is their best seller, given that sparkling water sales have been surging at a time when traditional high sugar soda drinks have mostly been stagnant or even dropping. As a result, the stock soared up until last year, but is still up by over 135% over the past 5 years, despite crashing by over 50% from their 52-week high. And this completely correlates with their dramatic drop in revenue growth that used to be close to 20%, later crumbled to only 4% growth last year, and is expected to actually decline this year by negative 5% and then be flat the year after, despite the broader market continuing to grow. That's likely due to the bad press they received from a recent lawsuit, and also because of the rise in competition from brands like Sparkling Ice and PepsiCo's Bubbly that continue to outsell them on Amazon. Now, their PE ratio is about 10% lower than the sector, but I don't think that's a big enough discount for the really bad business performance. So for me personally, this is still a D tier stock that I'll put in front of Elf because of the better valuation and the potential to be a leader in the sparkling water market. But in the end, I just think that there's better stocks out there, including PepsiCo, that gives you exposure to the market through Bubbly, which in my opinion has a better chance of being the market leader, while also paying you a very nice dividend, and it's a much bigger and safer company to invest in as well that is more diversified in my opinion. By the way, Fizz does pay out a special dividend on occasion, but with recent weakness, I don't know how likely we are to continue to see it in the future. Anyway, moving on to stock number 4, that's going to be the only stock on the list that I actually own myself, and that's the very popular Tesla at about 11% of his portfolio, and he is currently up around 14% on this position. Obviously, Tesla is the world leader right now in electric vehicles, which is an enormous deal as EVs are expected to eventually overtake traditional ICE vehicles in sales, and Tesla is even diversified into autonomy, energy, and have plans to launch a robotaxi fleet service as well. Sales have been absolutely soaring, climbing by well over double-digit percentages every single year, but unfortunately Tesla is not yet a profitable company, and as a result they've lost over $500 million over the past year, although that's not nearly as bad as something like Uber, and I do think that sustained profitability will likely come within the next year or so, given the Chinese factory and the Model Y, both of which I expect to drastically improve margins. In any case, the stock hasn't performed very well, only climbing by 15% over the past 5 years, and is actually down over 30% from their highs. Their PS ratio is pretty high at over 100% higher than the sector, but with their growth, I could see that improving very quickly. So even though I still consider Tesla a speculative stock because of the lack of profitability, I think they are probably the best spec stock out there, and I'm going to put them as the first stock in the A tier, as I have very high hopes for them over the long term. As a growth investor, Tesla really excites me. Okay, now we're breaking into the top 3 largest stocks, and coming in at number 3, that's going to be Cirrus Logic at about 15% of his portfolio, and he is currently up almost 40% on this position, which is very impressive. Now, Cirrus Logic is known for making audio chips for devices like smartphones, and their largest customer by far is Apple at around 80% of their sales during the first 9 months of their fiscal 2019. On one hand, that gives them a very reliable customer, but on the other, it leaves them with not a very well diversified business. So if Apple was to ever drop them, then they would be in huge trouble. Although Cirrus has stated many times that they are working very hard to diversify, especially into mid-range smartphone makers, which would be a huge market and opportunity. In any case, the stock has soared by 172% over the past 5 years and over 60% this year alone. Even still, their valuation looks pretty good with a forward PE and PEG ratio that are 36% and 19% lower than the sector respectively. Performance hasn't been very strong though, as they've been so heavily reliant on iPhone sales that have really struggled in recent years, leading to multiple down years for Cirrus. So while I think that the valuation does look attractive, and I actually think that iPhone sales are doing well right now with the iPhone 11 and will probably do even better with iPhone 12 that will feature 5G technologies, I just think that Cirrus is too heavily reliant on Apple, and to be honest, I think I'd rather own Apple stock itself rather than Cirrus Logic. So I'll put them in the B tier, but behind Tapestry and Wynn. Okay, coming in at stock number 2, that's going to be Skyworks Solutions at about 17% of his portfolio, and he is up around 13% on this position. Now, Skyworks is known for making a number of components that are used in electronic devices, including smartphones, but unlike Cirrus Logic, Apple only makes up less than half their revenue, while their broad market segment in industrials, IoT, automotive, healthcare, and so on makes up over a quarter of sales, and they expect these areas to explode in the future thanks to 5G. As a result, the stock has climbed by over 60% over the past 5 years and is up close to 30% this year alone. But the interesting thing is that their valuation is still incredibly cheap, as their forward PE ratio is over 50% cheaper than the sector, while their PEG ratio is over 100% cheaper as well. Unfortunately, their sales are expected to be crushed at the conclusion of this year, dropping by about 14%, but that's mostly because of the trade war, the tariffs, and the Huawei restrictions, which, by the way, Huawei accounted for a double-digit percentage of their revenue at around 12%, so that's obviously a very big deal. Now, if a trade deal does get done, Huawei restrictions are lifted, and 5G turns out to be as big of a catalyst as people think, then this could actually turn out to be a very high-flying stock once again. And at its current valuation, I have to admit that it looks very attractive, considering that they also pay out a nice dividend that yields over 2% and has a payout ratio of only less than 25%. So Skyworks is going for sure in the A tier and only behind Tesla, because I like the growth story a little bit more of Tesla, but Skyworks is probably a somewhat close second. Okay, and that leaves us with stock number 1, and that's going to be Facebook at about 20% of his portfolio, and he is currently up a massive 24% on this position. Now, you guys definitely know Facebook. They have a gigantic number of users across Facebook, Instagram, and WhatsApp, and they have an enormous balance sheet, and they continue to generate very large sales through digital advertising, which is a market that will only get bigger over time. As a result, sales continue to soar by gigantic amounts, growing by 37% last year, and is still expected to grow another 26% this year and 22% the year after. The stock has justifiably climbed by over 160% over the past 5 years and close to 45% this year alone, but even after the huge run-up, the valuation is still pretty attractive with cheaper PE and PEG ratios than the sector. Given how massively large Facebook is, yet they continue to grow and the valuation is still reasonable, I'll have to choose Facebook as our S tier stock, our god stock of the day, as I see them likely performing very well over the long term. So there you have it, guys. In the S tier, we have Facebook. In the A tier, we have Tesla and Skyworks. In the B tier, we have Tapestry, Wynn, Cirrus Logic, and iRobot. In the C tier, we have Uber and Nordstrom. And then in the D tier, we have National Beverage and Elf. So what do you guys think? Would you make any changes to this tier list? Or do you pretty much agree with my overall assessment? Let me know down in the comment section below. I think overall Jeremy's portfolio might be a little too reliant on traditional retail, so I would probably mix it up with a disruptor, maybe something like Amazon, and I'd probably look into some very reliable companies in the tech space that have a lot of future potential that maybe pay a dividend as well, something like Microsoft. I know what you guys are thinking, those are my two largest stocks, so yes, I'm being biased, but I think that those would add maybe a little bit of stability, maybe add to his foundation, which, by the way, if you look at the stocks the way I rank them, the ones that I put at the highest tiers, those are the ones that I feel are less risky, and the ones that are more risky I put at the bottom tiers. Well, those ones that are less risky, those are actually his largest positions. So I actually agree with the way that he's structuring everything, because he's limiting his exposure to those higher risk stocks, which are the ones that I put at the bottom of the tier list. And if you look at Facebook, which got the S tier, that is his largest position by far. And I think it makes total sense. Facebook looks like a stock that you really can build a portfolio around. So anyway, I think, hats off to Jeremy. He's done an amazing job. His stocks have performed incredibly well. And, so all the praise to Jeremy for sure. Anyway, I hope you guys enjoyed this video. If you did, make sure you hit the like button, subscribe if you haven't already. And thanks for all the support, guys. I'll catch you in the next video. Take care. Bye-bye.